day trading, right? Day trading, every day we provide 3 bullish, 3 bearish trade ideas. Today, Campbell's soup was the trade idea. Again, where do those prices come from? They come from stock forecast toolbox. The idea is that if the market is down pre-market, you buy at 46.38. Where's this magic number came from? It came from stock forecast toolbox. Stock forecast toolbox, model predicted $46.38. It's predicting an update today. And again, we have a program that ran and basically says, you know what, we've been doing pretty well in the past predicting consumer staple stocks, especially Campbell's soup. And if the stock reaches 46.38, then you would enter this trade. Today's low was 47.04. I assume this data is correct. Let's just double check that. All right, so 47.04. So we haven't reached that level. If you bought it at the open price, right? If you bought it at the open price, 47.24, you would be down. 47.12, you would be down 12 cents. If you waited for the predicted low, you would not be in a position. So this is an example of ActiveTrader. Again, you have entry 1, entry 2, 1% stop loss, 1% target gain, and the recommendation is to put half of the trade at the original entry point, and if the price drops by 0.5%, enter the second half of the trade. So holding time is usually I'm do day trading. I don't carry a position overnight. Some people do carry a position overnight because they do see momentum behind consumer staples, let's say in this case, and they want to have exposure short term, even if the trade went against them. That's fine. You can do that. Just always follow the rules in terms of allocation. That for day trading, you don't want to lose more. It should be less than 1%, your maximum loss. If you get your position overnight, you should reduce your position, but it should be less than 5%. So your total position should be less than 5% of your portfolio, your maximum loss. All right. That's ActiveTrader. In similar fashion, sorry, you can, instead of buying Campbell's soup for 100 shares would be for $5,000. So instead of spending $5,000, you can buy 100 shares for $90, right? So that's a difference between stocks or options. And again, the question is always, where's this magic number came from? We're buying deep in the money calls that expires in the current week to minimize the extrinsic value, because we're still, the prices of the options are determined by the moves of the prices of the stock. So 45.50 plus 90, this is where the $46.40 came from, right? This is the $46.40, right? We're rounding up. So we're just taking deep in the money call and subtracting the price of the stock. And that's where the 90 cents came from. Very often the question would be, well, if it never reached the 90 cents, what if it opened up $1 or $1.10? This is where you put, you know, plus minus standard deviation of error. You have a choice, right? It's the same idea. If you wait for the predicted low, well, it never reached. You can buy at previous close, plus minus 10 cents. So that's where it becomes at your discretion to determine what price point you want to enter, right? If it hasn't reached. If it doesn't reach, then you just don't get into the trade. If you really want to get in trade, because if you look at the support, right? Let's say you see CPB, right? Let's say you do see at 47.04, this is a good support, right? It goes back to October 10th. Okay, so then you can buy it at 47.03, 47.04, and you have to change the price. All right. Can you please explain strategy of entry 1 and entry 2? Well, let's look at ActiveTrader, right? So ActiveTrader, let's do the stock. Would be probably easier. So let's say I decided to enter, the stock reached 47.05, right? That's yesterday's support, right? So let's say it reached 47 or 47.05, even right now 47.13. So I'm in this trade, I buy it at 47.13. I would put only half of my usual entry size, because yesterday we can actually, the price might drop to next level of support is around 46.80. So 46.80, 47, half a percent of $47 is about 20 cents, right? So half a percent from 47.13 to 46.80, that's that half a percent. So if I entered at 47.32, half a percent would be roughly 47.08, right? Half of 47, 23 cents, 24 cents. So this is the idea, is that you buy only half at the original entry price, and you put the second half at if the trade goes against you by half a percent, because in this example, we're going back to October 7th for the support. If we do break 46.82, then you would exit out of the position, because there's not much support, and most likely it will reach October 9 low of 46.40. You don't know, you don't want to risk more than 1% of your portfolio, right? So that's the idea. Right now, if I buy the trade, I would get in at 47.13, even though, Campbell soup right now, market rallies, so defensive sectors are down, right? So it makes sense. So you would trade against the trend, and you don't want to trade against the trend. But let's say I do want to get, let's say I think that, by the end of the day, somebody's going to tweet that there is no agreement, and, consumer staples will rally, and, risk on asset classes will sell off. Then, I can buy it at 47.13. If it drops to 46.80, I'll buy the second half, and with the idea that if it breaks 46.80, I would get out of the trade.